Welcome back, Mr. and Mrs. Griffin. Today I'm going to present a comprehensive financial plan that I prepared for you, and we'll discuss how we can work together to utilize your capital and your earnings to attain your financial goals. And John and Jackie, you had mentioned as your primary goals education funding for Jack, Jill, and Jane for a 4-year state university, like to consolidate your debt, and also looking to retire at age 62 with 70% of pre-retirement income, excluding Social Security, or also considering retiring at age 65 with 80% wage replacement ratio, including Social Security, which would be $20,000 for John and $10,000 for Jackie at a normal retirement age. And last but not least, you also wish to review your risk management portfolio, investment portfolio, and your estate portfolio. Taking a look at external data, economic information really hasn't changed much since we met last, but I'll go over it briefly. Inflation is expected to stay at 3%, education inflation at 5%, bank lending rates for 30-year conforming mortgages, you can get a rate at 4%, and refinancing costs are at 1.5% of any mortgage amount. The investment returns for the market are expected short or long term to be at 8.5% and the fixed income investment return at 6%, while treasury bill rates or risk-free rate is around 3%. Now I prepared your balance sheet and it summarizes your current assets with $10,500 in cash, approximately $80,000 in investments, and personal use assets of $498,000. If we deduct your current liabilities of $344,546, your total net worth today is currently just shy of $245,000. So that's a great accomplishment here. And if we take a look at your current income statement, where we subtract your current expenses from your income, the first thing that jumps out at me is a negative cash flow of $21,198 per year. Now that's by how much you are currently overspending your income. And even though your main concern that brought you in was education funding, I think we need to address current shortcomings prior to being able to commit to additional spending. And I know reducing debt was your second biggest concern, so let's take a look at the analysis of some of this data, which are summarized in your ratio analysis, the 3-panel approach, and the past asset allocation analysis, which will definitely be able to show us where the deficits are and will also allow me to make recommendations that will fix some, if not most, of the problems that I was able to uncover. For the ratio analysis, your emergency funds are too small. Typically, you should be able to cover 3 to 6 months of non-discretionary expenses, and you're currently only at 1.68. The housing ratio, you are above the recommended 28%, meaning you spent more on your mortgage in relation to your income than recommended, and the housing ratio too is also above the 36th percentile, meaning your non-mortgage debt is at a higher percentile to the income than recommended. Your savings rate is also low, and the amount saved for retirement is too little, and your return on investment hasn't been in line either. But all of that is actually already step 2 or a second part of our presentation here today. We'll come back to retirement investment in the second part of the discussion. Let's take a look at the 3-panel approach, which is a great way to look at your goals by 3 priorities. First, it takes a look at your risk management. And with 1 income, low savings, and high debt obligations, any emergency could really pose a financial risk on your family that you need to protect yourself from by putting adequate insurance in place. I analyzed your insurance and we'll be able to show you that. And after taking a look at your debt, we also want to recommend some changes to some of your policies to ensure adequate coverage. The second panel takes a look at your short-term savings, investments, and debt management. And as I pointed out in the ratio analysis, we'll evaluate the adequacy of the emergency fund, the proportion of income spent on housing, and the proportion spent on non-mortgage debt. Thirdly, we can now approach our third panel. The main reason you're here is the long-term savings and investments. So here we'll address your education, retirement, and estate planning. The short-term recommendations we'll discuss are those things we can act on over the coming weeks that will have an immediate impact on your financial profile. By making these changes now, you'll be better protected against risks and you'll be in good shape to meet your longer-term goals for education and retirement. If I were to prioritize the things that I would like to address today, I would like to start with debt management and discretionary cash flow issues, then cover the insurance or risk management issues, estate planning issues, and then finally come to your long-term goals, education, retirement funding, and investment portfolio review. And as we discuss our recommendations, be sure to ask for clarification on anything that's not clear to you. So let's dig into the debt consolidation here. You've done a great job building for your life, your family, you have 3 children, a house, and you're able to provide for all that. And you've done a great job managing your debt, and it was good that you recently made that lump sum payment towards the bank loan you took out. And I'm very glad you came in, because after taking a look at your balance sheet and income statement, I think we could rearrange a few things that would help you turn things around. Now, John, you were playing with the thought of selling your ATV, and Jackie, you're willing to sell one of your stocks. I would recommend to go ahead and sell that ATV and sell the stock A for $43,541. So with the $47,000, you could pay off your credit card, the student loan, and you also can pay down more on the bank loan by $6,662. And I'm going in that order to eliminate the highest interest charging debt first and then work myself down to get that debt consolidated. Since you also have a home equity line of credit with a $50,000 credit limit, you can additionally pay off your car for the $15,748 and the remaining balance of the bank loan of $1,477, which will be a balance on the equity line of $17,225, which you could initially commit paying $300 per month. And that would actually eliminate all of your debt down to one $300 payment. And this, in addition, will allow you to refinance your primary mortgage, which you had thought about. And the strong debt management over the past 10 years will allow you to easily qualify for an excellent rate of $4,000. And since the mortgage refinancing does take 1 to sometimes even 3 months, depending on how the lender is working, it does make sense to use that home equity line first, so you have a first breather on all the debt payments that allows you to take your time, and then you can consolidate both the first, the primary and the secondary mortgage, and the balances are $280,000 plus the $17,000. Which is a total of $297,000, which will result in closing costs of $4,455, which will bring your new mortgage balance at $301,460. That will result in a new payment of $1,435, which is less than your current mortgage of $1,970, and it eliminates all non-mortgage debt. So consolidating your 2 mortgages will reduce your debt payments annually by $43,803. And I included an amortization schedule that I will include in your take-home package. Next, you can safely reduce your tax withholding from the $15,000. I know, Jackie, you'd mentioned you hadn't done the calculations for this year, so I went ahead and took took a look at this, and as another way to accumulate an additional $8,700 on an annual basis is to change your withholding beginning in the current year 2014, so that over the coming 12 months you will have an additional $8,700 in income to build liquidity, invest, or cover any funding shortfalls. So this tax analysis summary shows the impact that our plan will have on your taxable income. Your adjusted gross income will be lowered if you contribute more to taxable savings like your 401k. Then by subtracting the big itemized deductions for 2013, such as your property taxes, the mortgage interest, claiming 5 dependents at $3,900 each, you could bring your taxable income to just under $42,000, which is closer to the 15% marginal tax rate, and this would make your current withholding too high at 35% of taxable income. Thus, I recommend you lower your withholding to $6,300 or 15% of your taxable income, and the end result is an additional $8,700 that John will bring home in income over the year versus having it withheld for taxes and giving the IRS a free loan. Last, we'll also make some minor adjustments to your investment allocation to increase diversification, but the past analysis we'll discuss later when we get to retirement and education. Insurance. You have adequate health insurance and homeowners insurance, although slightly under the recommended coverage for the homeowners. There's no room at the present time though for improvements. However, your car insurance premium could be lowered to $700 per month if you're comfortable increasing the deductible to $500. The life insurance for Jackie you were offered is an outstanding deal that you shouldn't pass on. Purchasing 30-year term life insurance for Jackie in the amount of $780,000 for coverage for only $280 per year is an outstanding deal. I wouldn't pass on that. So strongly recommend taking that. Also recommend increasing John's life insurance since the recommended coverage amount should be at least 12 times the annual income. So his current $25,000 for the employer is way too little. If something were to happen to him, if he would take out a $1 million 30-year term, it should cost about $850. So that's something I would recommend adding on. Another great solution would be the personal liability insurance that the car insurance fully qualifies you for and would protect your family from any other liability you might face up to $1 million, and you would only have to pay $250 per year. So that to me would be a good expense. I would recommend holding off on long-term care and adjusting coverage for disability. Although those are things missing right now, I think we want to focus on building up your emergency fund and making all the other changes, and then come back as we get along with this process at a later time. Another way to protect your family in case of a catastrophic event is to plan for your estate. And really, you want to just get 4 main documents in place: get a will, durable power of attorney for healthcare, and advancement medical directives, and then name guardians for trustees for the children, and establish a living trust and put assets in to avoid probate upon death. The estimated cost for that is usually around $1,000, and if you don't have an attorney, I can get you names of a couple of good ones I've been working with. So just let me know if you want to find your own attorney or if you want me to provide you one. So by selling assets to pay off the non-mortgage debt and freeing up cash to create more of a liquidity cushion, you will save thousands on interest expense and be better prepared for short-term expenses. In addition, you will be able to lower your mortgage rate and withholding rate and begin saving more for your future long-term education and retirement goals. By adjusting your insurance levels for auto, life, personal liability insurance, you will be better protected and you will be better prepared for unknown and uncontrollable risks. By creating estate planning documents, you're safeguarding your family and putting into place your wishes in case of a sudden catastrophic or tragic event. So let's finally take a look at your long-term goals. And I'm sure you have realized it will be extremely difficult to achieve both. Retirement at age 62 with 70% wage replacement ratio and full funding for all three children's college education. This would acquire, and I did the math and supplied the retirement education schedules, this would require an additional $26,202 per year. The good news is that if we were to implement step 1 that we just discussed and consolidated your debt, we would be able to turn your negative into a positive cash flow of $17,061. So this allows us some alternatives to consider and to make up for the $9,141 shortfall. So we got $17,000 in the plus. We're short $9,000 to meet both goals. So let's take a look. Education. I understand education is your number one priority, and as a mother of two, I've gone through a similar planning process to find some ways to prepare. Since you're fortunate to have grandparents who are willing to contribute to your children's education, I would recommend to have a thorough discussion with them in order to see what they would be willing and able to contribute. Also, consider merit-based scholarships, student loans, or if they take part of the education at the community college, their expenses will be much lower. And even though I'm recommending paying off and closing the home equity line of credit, in a couple of years you can re-qualify for one, have a low-cost financing option at that point as well. Please review the education expense that I prepared in the schedule, and you will see that if the grandparents were able to gift, let's say $14,000 per year for the children's education fund until they stop working, it would get you started, and you would be able to contribute as needed later on. And hopefully John will get salary increases that can help, and grandparents would also get a big tax break for themselves. Jackie, I know you were debating to go back to work. However, if you're expecting to make $26,000 while expecting a cost of living increase of $21,000 due to the child care and inflation, you might come out negative. So you might want to consider staying home rather than paying to go to work with no additional gain and potentially less money as if you didn't. There are a lot of options here depending on what the grandparents are willing to do as well. So the full amount to finance 4 years of college for all three children would be $14,925 per year. Or if the grandparents could start the 529 plans with $10,000 per child, it would bring the cost down to $11,226 per year. A meeting with the grandparents would be the first step, basically, to determine what amount are they willing to contribute either upfront or on an annual basis. And then the next step will be to decide on which retirement option you wish to pursue. So let's take a look at the retirement schedule I prepared. To retire at age 62 with 70% pre-retirement income, you will require annual savings of $23,041, and your current 401k contribution is $5,882. This leaves you with a shortfall of $17,159 per year. If you considered retiring at age 65, you will have a more adequate retirement budget, assuming you live to age 91, and 80% wage replacement will require an additional $5,127 per year in savings. If you waited till age 67 with 70% wage replacement ratio, you would look at an additional $4,563 per year. So as you can see in the calculations, waiting till 65 for retirement would significantly reduce the amounts you would have to save annually, although retiring at age 62 is possible if the grandparents are willing to pick up the slack, or if you guys like to consider other alternatives for college funding as well. Retirement at age 67 does not seem to give enough of an annual savings reduction to be considering at this point, so I'd probably not look at this option at this time. Your risk tolerance. Let's talk about the investment. The risk tolerance questionnaire reflects a moderate tolerance pass score of 19. So Jackie, if we take a look at your other stock, I would recommend selling it as well and moving the funds into a better diversified portfolio that would follow the asset allocation model, targeting 8.5% rate of return rather than the 4% it's been averaging so far. And this would also pertain for John's 401k allocation. No matter which retirement option you choose, I recommend bare minimum to increase the annual contribution to at least 10% at $8,500 to max out on the tax savings, and to reallocate also the past 19 risk score model that would increase your return. So on the rebalance allocation model slide, you can see how this would work out to rebalance your stock portfolio, your 401k, and also we can have similar allocations within the 529 plans if you were to set those up. So your take-home package includes a lot of options to look at and consider: the engagement letter, the investment policy statement, the past questionnaire, and also the statement of income and expenses, balance sheet and ratios for the current year, and with recommendations applied for the current year and 5 years out, as well as the 3-panel support. Your current net worth is at $244,861. My projected net worth for you in 5 years, if you were to implement these recommendations, would take you to $449,117 in net worth in 5 years. So please take this home, and once you've decided what recommendations you will implement, we will help you make those changes and continue to adjust the plan by developing contingencies as time moves forward. We're providing you with these reports to take with you and to help you make your decisions. Let's meet in 2 weeks and start implementing the process. We're always here to answer any questions that come up along the way, and we really plan to meet with you at least every 6 months to monitor and, if necessary, adjust the plan. Do not hesitate to contact us if you have any questions. Also, it's very important to inform us if there are any significant changes to your situations. Mr. and Mrs. Griffin, I really appreciate you coming in. I look forward to seeing you soon again. Thank you so much.